Did you know that you can sell your house and pay no income tax under certain circumstances? Did you know that you can sell your business and pay no income tax under certain conditions? If not, this video is for you, and I will include timestamps in the description of the video so that you can move to the spot that interests you the most. Let's discuss the selling of your house. I think at this point pretty much everyone knows about Section 121 that allows an exclusion for single filers. It's $250,000, and if you file as married filing jointly or as a surviving spouse, you get $500,000 to exclude from the realized gain on the sale of your principal residence. However, there are a few tests that you need to meet and a few conditions that you also have to meet, and if you don't meet them, you can still take an exclusion under certain conditions, but the exclusion will be reduced. So we'll discuss all of that right now. So the first condition is a set of two tests that you need to meet. It's ownership and usage test. And when I say usage, it's did you live in this home of yours or not? And the test is the same for both aspects. You need to own and live in this home for at least 2 years out of 5 years preceding the sale of the residence. Please note that you don't need to meet the ownership and usage test concurrently at the same time or continuously, meaning that you can live in your home for a year, then move somewhere else for a few years, then come back and live here for another year. As long as you fulfill the 2 years out of 5 preceding years, you're fine. Another important requirement is that you must not have used this exclusion already for 2 years preceding the sale of your residence this time. And if you don't meet any of the requirements that I've just discussed right now, don't be discouraged. Keep watching. Because you may still be able to take this exclusion, but it will be reduced. As I already said, married filing jointly can utilize $500,000 to exclude from the realized gain on the sale. However, when it comes to the tests, it works slightly differently because when it comes to usage, both spouses need to meet this test. And when it comes to the exclusion, both spouses must not have used this exclusion in the prior 2 years. However, when it comes to ownership, only one spouse needs to meet the requirement of owning the place for at least 2 years. It doesn't necessarily need to be the two spouses owning this place together. If you fail to meet the requirements I've just specified, the ownership test, the usage test, and the fact that you cannot use the exclusion in the past 2 years, you can still qualify it for a reduced exclusion, and it applies to you if you sell your home due to one of the 3 reasons. First reason, if you sold your house due to health reasons, if you sold your house because of employment or your employer moved and you have to move closer to your employer, or if there were some unforeseen circumstances and you had to sell the house because of that. So now let's discuss a more interesting and slightly complicated case of selling your business. So one big thing to note is that the business that you own and you want to sell and pay $0 in tax needs to be a C corporation, because what we're talking about is Section 1202, and that is qualified small business stock. And you can exclude up to 100% of your gains on sale of this QSBS stock under certain conditions, up to $10 million. As I've already said, one of the requirements is that the business needs to be a C Corp. However, this exclusion applies to non-corporate taxpayers. So another thing is that you need to hold the stock of this C corporation or your business for at least 5 years. The next requirement is that it needs to be a small business. As the name suggests, it's qualified small business stock, and small is clearly defined specifically for this section as a business that is immediately before and immediately after being created, its gross assets do not exceed $50 million. In addition to all of this, the business, the C corporation that you're running, needs to be involved in the active trade or business, which means that at least 80% of the assets that you have in the business are used in the active trade or business. Not only does the business need to be involved in active trade or business, but it also needs to be a qualified business. And the qualified business, I've already discussed this in one of my videos previously, but qualified business for this section is the same. It's any business that does not rely on your skill or reputation. So, for example, in the field of health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or any other business that you can come up with that relies on your reputation or skill. One other requirement for this section 1202 to work for you is that the shares that you purchase in this C corporation, the small business stock, you need to purchase it at the original issue. So you can't repurchase it from someone else. It needs to be the original issue purchase. There are a few other requirements that you need to meet, but they're more technical and kind of apply to special circumstances. So always remember to consult your tax advisor or contact me if you have additional questions regarding that. And obviously, remember, these videos are not tax advice or professional advice. As I've already mentioned, the exclusion limitation is $10 million. If you have a gain more than $10 million, you may potentially be able to exclude more than that, but in that case, you'll have to use a formula, in which case you take the adjusted basis of the stock in the small business stock that you own and you multiply by 10. Let's look at a quick table to see the actual exclusion amount, because I did mention that you can exclude 100% of the gain up to 10 million, which is true. However, it only applies to the stock that you purchased after September 27th, 2010. If you purchase shares before September 28th, 2010, the exclusion is reduced. One very important thing that a lot of people do not know when it comes to section 1202 is that you cannot double dip. So if you know the regular rules for capital gains, I said it in the previous video, the maximum rate normally for capital gains is 20%, it can be 15% or even 0%. If you're using the section 1202 and your gain is higher than the limitation, or for example, you're only eligible to exclude 50% of the gain or 75% of the gain and the rest is taxed, it is taxed at 28%. I hope this information was useful to you. As I've already said, these videos and the channel overall are not professional advice, they're not educational. You should always contact your tax advisor or contact me. You can find my information at liliacpa.com or contact me directly via LinkedIn. All the links will be in the description of the video, and the first consultation is free, so you have nothing to lose. I hope to see you in the next video, and take care in the meantime. Bye.